Welcome to today's Explainer. We're jumping right into the thick of it today, tracing a massive and fascinating theme, capital in motion. Because look, if we want to understand our economic future, we absolutely have to follow the money. So we're going to trace exactly how, and more importantly, why, global institutional investment is shifting in 2026.
Okay, let's dive into this. Where exactly is institutional capital flowing today? It's June 2026, and large-scale money is moving across borders in ways that reveal a whole lot about where our global economy is headed. You see, it's not just about isolated financial deals. It's really like a giant puzzle. We're spotting the larger patterns in how massive institutional wealth is being deployed across a super complex global market.
Here's our quick roadmap for today. We'll start with tracking capital in motion. Then we'll look at the battle for TAP, followed by aviation market signals. After that, we'll shift gears into global wealth and tech, and finally wrap things up with navigating corporate compliance.
Let's start with Section 1, Tracking Capital in Motion.
This right here is going to be our core analytical lens for the day. Our analysis is directly inspired by financial reporting that focuses precisely on following where real money is being deployed and what those financial signals actually reveal about global momentum. We're tuning out the day-to-day noise and those flashy, short-lived headlines. Instead, we want to understand the true underlying flows of institutional investment. We're talking about trillions of dollars in corporate capital looking for a long-term home. Where are the smartest corporate balance sheets actually placing their bets for the next decade?
That brings us to Section 2, the battle for TAP. And this brilliantly illustrates a major strategic choice that large corporations face when deploying all that capital. To really understand these massive flows, you've got a perfect anchor case study happening right now in the incredibly competitive European aviation sector. Think about it. You can rely on organic expansion, right? Trying to build out new routes entirely from scratch, which, let's be honest, can be as slow and painful as a multi-hour flight delay. Or you can take the other route, acquiring an ownership interest, grabbing strategic equity in existing national carriers. German aviation group Lufthansa has reaffirmed its strong interest in acquiring a minority stake in TAP Air Portugal. They are actively choosing that second strategy, which signals a massive institutional appetite for strategic aviation investments as Portugal advances its privatization plans.
So what exactly is Lufthansa trying to buy here? Just look at this breakdown of the strategic assets at play. Under network expansion gains, a stake in TAP offers immediate, strengthened access across the Iberian Peninsula, South America, and those highly lucrative transatlantic routes. It's a real game changer. But then, look over at the operational infrastructure gains column. Lufthansa has outlined plans to establish a maintenance hub in Portugal. That tells us this capital allocation extends way beyond just holding some equity on a balance sheet. It's a concrete long-term commitment to physical operational infrastructure.
Let's move to Section 3 and see how this builds into broader aviation market signals.
We're going to zoom out from that specific Lufthansa and TAP deal to look at the macroeconomic picture, because the competitive tension around this privatization sends four absolutely crucial signals to institutional investors. First up, capital is continuing to flow heavily into strategic infrastructure assets, even with broader global economic uncertainty hovering in the background. Second, cross-border acquisitions are still the primary, critical engine for deploying corporate capital. Third, we're seeing active, intense consolidation as carriers ruthlessly compete for scale, network efficiency, and premium international routes, especially as their balance sheets have improved post-restructuring. And finally, governments are increasingly leaning on partial privatizations. They want that private investment for sure, but they're structuring these deals so they can keep their hands on the wheel and maintain strategic oversight of their national assets.
Moving right along to Section 4, Global Wealth and Tech.
Now, I want to show you how universal this trend actually is. This exact same institutional drive for scale and structural dominance is happening simultaneously in completely different corners of the global economy. Consider this fascinating juxtaposition. On one side, we have Firmus Technologies over in Australia. They're partnering with NVIDIA to expand affordable AI computing infrastructure, which is going to help emerging AI companies deploy advanced applications at scale. But then, look at the other side. We've got Goodbody expanding its private wealth footprint through a major acquisition in Belfast. Just think about that for a second. Advanced AI tech infrastructure on one side, and ultra-high net worth wealth management on the other. They are completely different industries, but they share exactly the same underlying financial momentum, racing to consolidate and build larger, more capable platforms.
The motivation behind that Goodbody Belfast acquisition is perfectly captured by this quote, highlighting the growing race to build larger platforms serving billionaire families and ultra-high net worth investors. Competition among family offices is intensifying. Why? Because managing billionaire wealth today requires way more than just a really big piggy bank. It requires massive scale. So just like airlines are buying stakes in national carriers to lock down premium routes, financial firms are acquiring regional players to lock in access to premium global wealth. The underlying theme? It all comes back to capital consolidating around scale.
And that brings us to our final stop, Section 5, Navigating Corporate Compliance.
Now, what's really interesting about this slide is the year itself, 2026. Moving massive amounts of capital across borders isn't just about finding the right asset to buy. As capital moves globally, it has to navigate an incredibly complex, rapidly evolving web of government regulations. And 2026 is proving to be an absolute turning point for new regulatory shifts taking effect worldwide. Governments are fundamentally changing the rules of the game, and institutional investors have zero choice but to adapt immediately.
Let's look at a major example happening right now in Asia. South Korea has just confirmed its tax law amendments for 2026, officially finalizing the decision that restricted stock units, or RSUs, are going to be excluded from preferential tax benefits. Think about the massive ripple effect of this single regulatory shift. It forces corporations to completely reshape their executive remuneration strategies. Seriously, you can build the biggest tech platform in the world or acquire the best airlines, but if the tax benefits for your top executives suddenly vanish, your entire corporate compensation strategy has to be rebuilt from the ground up just to keep your leadership talent from walking out the door.
And this strict enforcement isn't just happening in fancy corporate boardrooms with tax laws. It's happening right on the ground, disrupting everyday operational logistics. Take a look at the situation in Southern Africa regarding TCR, which stands for Temporary Customs Route Documentation. Transport operators involved in cross-border repatriation are being strongly urged to verify every single piece of their TCR regulatory paperwork and permits. If they fail to produce valid documentation, those repatriation buses will literally be turned back at the Zimbabwe border. So whether you're flying commercial jets across the Atlantic or operating transport buses across Southern Africa, stronger cross-border compliance practices have simply become non-negotiable for operational success.
So, the crucial point is this. We're watching a massive, globally coordinated movement of money. From Lufthansa seeking a strategic stake in Portugal's national airline, to firms building AI scale-down in Australia, all the way to governments in South Korea and Zimbabwe tightening their regulatory grips. As governments increasingly blend private capital with their own strategic oversight, how will the long-term impact of these public-private asset transfers reshape our future economy? It's a very delicate, high-stakes balance of power out there, and understanding it is absolutely key to navigating the future of global finance. Thank you so much for joining me for today's explainer, and always keep questioning what's really behind those financial headlines.